walk into a medical clinic and check a patient's vital signs, there's this certain expectation that if the pulse is strong and steady, well, the patient is perfectly healthy. It feels like a clean binary.
Right. Yeah, the numbers don't lie. I mean, a strong pulse usually means the internal engine is operating, exactly as it should.
But then you zoom out and you realize this patient with the perfect pulse is, well, they're standing in the middle of a burning building.
Oh, wow.
Suddenly, those vital signs feel a lot less reassuring and a lot more like a temporary illusion. Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Today, we are looking at a market that is quite literally defying gravity while the room catches fire around it. So it is Monday, May 11th, 2026, and the U.S. stock market, it just hit new all-time highs today.
It really did.
Yeah, we aren't going to read you the exact decimal points, but the S&P 500 blasted past the 7,400 mark to close at 7,412.84, and the NASDAQ climbed over 26,200, closing at 202.74.12.
Nice.
But here is the massive paradox, right? Crude oil briefly breached $100 a barrel today amidst a really severe, rapidly escalating geopolitical standoff in the Middle East.
It is, the absolute definition of a macro paradox. You have just sheer euphoria in equities, particularly in tech, existing in the exact same moment as pure dread in the global energy markets.
Which is exactly why we are here. Our mission today for this deep dive is to help you understand the baseline you are operating against, and we'll do that by answering 3 core questions.
All right, so here is the roadmap. First, what set the stage before the U.S. session? We'll unpack the weekend's diplomatic breakdown and the massive global data drops.
Right.
Second, what moved markets during U.S. trading hours? Like, how did Wall Street react to a historic oil shock warning?
Right.
And third, corporate events recap and what to watch next, where we'll explore the tech maneuvers that are defying all this macro gravity.
And before we get into session 1, we always want to explicitly state that this deep dive is strictly for market context and discussion. I mean, we are analyzing the narrative and the underlying mechanics driving these moves. This is not personal investment advice or, a recommendation to buy or sell anything.
Exactly. We are just reading the vital signs to see how the system is holding up.
Right. So let's establish our baseline and dive into our first major question. Session 1, what set the stage before the U.S. session? Because, look, the weekend was anything but quiet. Mira, what was the global backdrop before the opening bell rang in New York?
Yeah, so we came into Monday with a very tense weekend carryover. I mean, it started with a massive diplomatic stalemate. On Sunday, May 10th at 3:44 p.m. Eastern Time, President Trump explicitly rejected a U.S.-Iran ceasefire draft.
And this was the one brokered by Pakistan, right?
Exactly. Brokered through Pakistan. He publicly called the proposal totally unacceptable.
And the sticking point there, it wasn't just a minor detail. It was about immediate physical leverage.
Right. Iran's proposal demanded immediate relief from U.S. sanctions on their oil sales for a 30-day window. Trump rejected that outright, and Iran fired back almost instantly.
Which everyone sort of expected, right?
Yeah, but they went hard. They refused to negotiate any further on their nuclear enrichment programs. They deployed deep roaming submarines, and critically, they began withholding clearance for UAE tankers trying to pass through the Strait of Hormuz.
No, wait, let me stop right there and I got to push back a little on the prevailing narrative I'm seeing on all the financial networks today.
Oh, how so?
When a geopolitical breakdown like this happens, the reflex in the market is to treat it like an unpredictable natural disaster. Like, oh, an earthquake just happened to strike the Strait of Hormuz. But if you view this through a game theoretic lens, it makes total logical sense. We are just seeing geopolitics as calculated brinkmanship.
Well, yeah, if we look at the calendar, the brinkmanship theory holds up perfectly.
Exactly. Look at what happens later this week. President Trump has a really high-stakes state visit to China coming up on Wednesday. Neither Trump nor Iran are acting irrationally here. They're both maximizing their leverage and testing the absolute limits of the other side.
Right, trying to see who blinks first.
Right. Trump wants to look unyielding before he sits down with Xi Jinping. Iran, on the other hand, well, they know that a spike in oil prices directly hurts the U.S. consumer, which is a massive domestic vulnerability for the White House. This isn't random chaos. It's a high-stakes poker game where oil is the ultimate chip.
And that brinkmanship, it's colliding with some really difficult global macro signals that dropped overnight. While everyone was fixated on the Middle East, China quietly released some very hot inflation data. This was on Sunday at 9:30 p.m. Eastern Time.
The inflation print that absolutely nobody wanted to see. Let's unpack the mechanics of that real quick.
Yeah. So China reported that its April Consumer Price Index, the CPI, rose 1.2% year over year. But more importantly, their Producer Price Index, the PPI, it surged 2.8%. And both of those numbers significantly beat expectations.
And for anyone listening wondering why we care about a factory price index in Asia, I mean, it's about the mechanism of global inflation transfer. PPI measures the cost for factories to produce goods, right?
Exactly.
So if a manufacturer in Shenzhen is suddenly paying 2.8% more for raw materials and energy, they don't just eat that loss. They pass that cost on to the wholesale buyers who ship those goods across the ocean, where they eventually show up with a higher price tag on the shelves at a U.S. retailer. It is a leading indicator for reaccelerating global inflation.
Precisely. And, the People's Bank of China knows they are walking a tightrope here.
Mm-hmm.
Just an hour before that inflation data dropped, at 8:20 p.m. Eastern Time on Sunday, they announced these sweeping interventions to try and stabilize their battered real estate sector. They are desperately trying to keep their domestic economy afloat without letting export prices run completely out of control.
So we have shattered peace talks in the Middle East, and we have the mechanics for rising inflation bubbling up out of Asia. And then we get to Europe, which is dealing with its own unique vulnerability right now. Heading into Monday morning, around midnight Eastern Time, European Central Bank official Kocher came out swinging.
Yeah, he did not mince words at all. He warned of imminent rate hikes in Europe, explicitly citing the risk of stagflation stemming directly from this Middle East conflict.
Which makes total sense because Europe doesn't have the domestic energy buffer the U.S. has. They are incredibly exposed to energy imports. If oil spikes, Europe's economy feels it instantly.
Right, and the dynamic to watch here is the currency. If the ECB is forced into hawkish policy while their economy slows down, it puts immense pressure on the euro. And we know currency weakness as imported inflation is a pressing danger for Europe right now.
Because everything gets more expensive.
Exactly. If the euro loses value against the dollar, buying that crude oil, which is, universally priced in US dollars, it becomes exponentially more expensive for them. It's a vicious cycle.
Okay, so wrapping up our first session, we entered the U.S. trading day with shattered peace talks, hot inflation mechanics firing up in Asia, and an increasingly nervous central bank in Europe. It was a highly volatile global setup.
Very much so.
But when the sun came up in New York, the narrative shifted from theoretical brinkmanship to physical reality. So we're going to take a really short break, and when we come back, we'll see exactly how Wall Street reacted.
Sounds good.
All right, let's transition right into our second session. What moved markets during U.S. trading hours? Because, Mira, given that incredibly tense global backdrop, how did U.S. markets digest this oil shock today?
It started with an absolute bombshell right before the bell. At 8:08 a.m. Eastern Time on Monday morning, the CEO of Saudi Aramco, Amin Nasser, issued a warning that basically stopped trading desks in their tracks. He stated that the world is facing the largest energy supply shock ever experienced.
Wait, let me just pause on that phrase. The largest energy supply shock ever experienced. The head of the world's biggest oil company does not throw a phrase like that around lightly just to make headlines.
No, not at all. And he backed it up with the physical logistics. With the Strait of Hormuz effectively blocked by this geopolitical standoff, Nasser stated that shipping traffic has plummeted from 70 ships a day down to just 2 to 5.
2 to 5 ships. The logistics of that are staggering. You can't just reroute 65 massive energy vessels overnight. There aren't alternative pipelines that can just magically absorb that volume.
Exactly. The math he presented is terrifying. He projected a loss of 100 million barrels of oil from the global market every single week this continues.
Wow.
And he warned that, even if the strait magically opened tomorrow, it would take months for the shipping logistics to normalize. You can't just flip a switch and re-split global energy traffic.
So the immediate price action makes total sense. I mean, WTI crude briefly spiked over $100 a barrel, hitting 100.37 before settling slightly lower at 98.4. Brent crude closed up nearly 3% at 104.21.
Yeah, huge moves.
And gold, like the ultimate physical safety trade, whipsawed violently all day, but ultimately closed very strong at 4744.880. But I really want to talk about how this filters down to the real economy, Daniel, because we treat energy shocks as a delayed consumer tax.
Yeah, explain how that mechanism works for the listener.
Well, when crude oil goes to $100, the U.S. consumer doesn't get an invoice in the mail the next morning, right? But over the next 4 to 8 weeks, that shock bleeds into everything. It costs $15 more to fill up the family car. The cost of an airline ticket surges.
Right, shipping costs go up.
Exactly. The diesel required to ship groceries to your local supermarket gets way more expensive, so food prices creep up. It silently but aggressively drains household discretionary income. And you could tell Washington was panicking about this exact mechanism today.
Oh, they absolutely were in full damage control mode. At 8:44 a.m. Eastern Time, White House advisor Kevin Hassett went on CNBC to aggressively downplay the recession risks.
What did he say?
He urged the Federal Reserve to basically look past this supply shock. His argument relied heavily on the fact that core inflation, which, purposefully strips out volatile food and energy costs, has only averaged 2.6% over the last 6 months.
Yeah, I have to push back hard on Hassett's neat little explanation there. I mean, is that just too broad of an excuse? You can't look a working family in the eye and say, don't worry, your core inflation is totally fine when gasoline is pushing towards $5 a gallon. You can't just strip food and energy out of a household budget.
No, you can't. And it's a highly dangerous game for policymakers to play. Ignoring a physical supply shock risks unmooring consumer psychology entirely, because central bank credibility anchors inflation expectations. If the Fed essentially shrugs at $100 oil, the public loses faith that the central bank is actually fighting inflation. And if people believe prices are just going to keep going up forever, they change their spending behavior today, which ironically causes more inflation.
And the White House clearly knows the consumer is going to feel this pain. Because later in the morning, around 10:50 a.m. Eastern Time, President Trump indicated he might temporarily suspend the 18-cent federal gasoline tax just to try and save consumer spending.
Yeah, it really shows how worried they are about demand destruction.
But Mira, this brings us to the most fascinating part of the day. This is the equity paradox we mentioned at the very beginning. We have historic oil shocks, hawkish ECB warnings, and emergency gas tax suspensions being floated. And what did the U.S. stock market do?
It completely ignored the macro dread.
It completely ignored it. The S&P 500 closed in the green, up 0.2%. Investors essentially shrugged. And if you think it's just, a few retail investors blindly buying the dip, look at the underlying credit markets. They didn't flinch either. We always watch credit spreads as the stress canary.
Yeah, let's unpack that analogy for a second. Why do we look at credit spreads?
So think of the corporate bond market like the tension cables on a giant suspension bridge. When the macroeconomic wind blows hard, you don't just look at the cars on the bridge, the equities. You look at the underlying tension cables to see if the structure's going to snap.
Right.
If big institutional money is terrified that corporate bankruptcies are coming, the cost for risky companies to borrow money skyrockets. The spreads widen. But today, high-yield corporate bond ETFs like HYG traded totally flat at 79.98. And investment-grade bonds, LQDs, stayed flat at 108.93. The cables didn't even vibrate.
So why is the market whistling past the graveyard? I mean, why aren't the tension cables snapping?
Because right now, macro narratives obscure micro risks. The overarching global story is terrifying, yes, but the micro story, the specific individual earnings power of the mega-cap tech companies that actually make up the S&P 500, is acting like an impenetrable shield.
Which perfectly sets up the final piece of the puzzle. So wrapping up session 2, we saw a massive historic oil warning met with swift White House damage control and a collective baffling shrug from U.S. equity and credit markets.
Yep.
We'll take a quick breather here. When we come back, we need to look under the hood.
Moving into session 3, corporate events recap and what to watch next. Mara, what were the key corporate developments today that allowed the market to completely defy gravity?
It all comes down to the tech behemoths and the relentless build-out of artificial intelligence infrastructure. Late Sunday night at 9:02 p.m. Eastern Time, a really revealing story dropped. The White House finalized the CEO delegation that will join President Trump for his high-stakes Beijing summit from May 13th to the 15th.
And the guest list is like a masterclass in American corporate dominance. You have Apple's Tim Cook, along with the heads of Meta, Cisco, Goldman Sachs, Visa, and MasterCard.
But the real story is the name that was noticeably missing. NVIDIA's CEO, Jensen Huang, was not invited to Beijing.
That is a glaring omission.
But a very deliberate one. It highlights the immense geopolitical sensitivity around advanced semiconductors right now. The U.S. government simply does not want its top AI chip maker doing high-profile, quote-unquote, smart business in China while tensions are this high.
But the stock market didn't even care that NVIDIA was sidelined from the summit, because the underlying demand for AI infrastructure is moving faster than geopolitical gravity can pull it down.
All right.
Normally, the rule of thumb is rates as gravity on valuations.
Right.
When interest rates are high, it pulls down the premium investors are willing to pay for future growth. But that fundamental rule simply isn't applying to AI hardware right now.
The demand is just insatiable, regardless of the cost of capital. Just look at the private markets and the sheer scale of the capital being raised. On Sunday at 5:37 p.m. Eastern Time, Cerebras Systems, a company that makes highly specialized AI chips, raised its IPO price range to between $150 and $160 a share, targeting a massive $4.8 billion raise.
In this macro environment, to target nearly $5 billion while oil is threatening a global recession is wild. And it didn't stop there. Monday morning at 8:20 a.m. Eastern Time, reports broke that SoftBank's founder, Masayoshi Son, is planning a staggering $100 billion AI data center investment specifically in France.
$100 billion in one single country.
It's unbelievable.
This proves that we have to view AI capex as an existential arms race. It's not discretionary spending for these companies or these nations anymore. Tech giants and sovereign governments believe that if they don't spend these billions on AI infrastructure right now, they literally won't survive the next decade.
It's a survival cost.
Yeah, that pure fear of missing out is completely overriding all the macro fears about oil, inflation, or interest rates.
It's an incredible phenomenon to witness. But I have to ask, how long can this digital economy boom before it hits the harsh limits of the real world? Because building a massive AI data center requires an astronomical amount of electricity, and electricity is generated by physical energy.
That is the trillion-dollar tension at the heart of this market. Ultimately, physical constraints cap the digital economy. You can design the most advanced, brilliant AI semiconductor in the world, but if the local power grid can't handle the load, or if oil at $120 a barrel makes cooling the data center fundamentally unprofitable, well, the math stops working. The digital cloud still relies entirely on physical, earthly infrastructure.
And that earthly infrastructure is currently sitting behind a blockade in the Strait of Hormuz. Which actually brings me to our closing bell joke for the day.
Oh boy, lay it on me.
Look, average investor sentiment right now is bordering on pure greed. Your tech and AI stocks are doing so phenomenally well that you probably feel like an absolute Wall Street genius staring at your portfolio today. But just remember to cash out a little bit of those massive tech gains before you leave the office.
Why is that?
Because with Aramco warning of a historic supply shock and crude oil flirting with $100 a barrel, you're going to need to liquidate at least 2 shares of stock just to afford the gas for your commute home. Enjoy the record highs and, maybe consider carpooling tomorrow.
Dark, but unfortunately a very accurate reflection of the day.
All right, let's pivot to the calendar. Mira, what exactly do we need to watch tomorrow, Tuesday, May 12th?
Tomorrow is an absolute gauntlet of critical data drops. Let's lay out the timeline for you.
Okay.
First, at 8:30 a.m. Eastern Time, we get the April U.S. CPI and real earnings report. Given everything we just discussed about inflation mechanics, this is the ultimate reset moment for Treasury yields and equities. We'll see exactly how much inflation is already biting the U.S. consumer.
That's a huge one.
Yeah. Then at 10 a.m. Eastern Time, the NFIB Small Business Optimism Index drops. This is crucial because it gives us a ground-level view of how smaller companies who, don't have the massive cash buffers of the tech giants are handling these sudden energy costs.
Right, the mom and pop shops.
Exactly. At 1 p.m. Eastern Time, it's a massive hour. Chicago Fed President Austin Goolsbee is speaking right as the Treasury is auctioning the new 10-year note. That auction will be a real-time test of global demand for U.S. debt amidst all this geopolitical chaos.
Okay.
And finally, at 2 p.m. Eastern Time, the U.S. monthly Treasury statement comes out, which will give us a fresh signal on the fiscal deficit.
That is a heavily tacked Tuesday. So let's unpack everything we've covered and leave you with a final thought to mull over. Throughout this entire aggressive rate hiking cycle over the last couple of years, the U.S. consumer has remained heavily insulated. We've seen fixed rate debt as a household shock absorber. Because millions of homeowners locked in 3% mortgages years ago, they haven't felt the immediate brutal pain of the Fed holding rates at 5%. But a sudden massive spike in the physical price of oil, well, That bypasses the shock absorber entirely. It hits your wallet at the gas pump today, it hits your grocery bill tomorrow.
It's an immediate tax.
Exactly. So the fundamental question you have to ask yourself is this. How long can this incredible AI-driven corporate earnings rally completely ignore a physical global energy blockade before the fundamental math breaks down? Can the digital brain continue to thrive if the physical body is starving for fuel?
That is the exact tension driving the reality of this market. We'd love to hear how you are weighing the AI infrastructure boom against the very real global energy shock. So please drop one short sentence sharing your thoughts and theories in the comment section below.
Thanks for joining us for this deep dive into the market recap. We'll see you tomorrow.